What if I told you that the secret to beating the market isn't staring at charts 10 hours a day? What if you could build a simple, lazy portfolio of ETFs that does the heavy lifting for you and still outperforms the classic S&P 500 index? It's not a myth, it's not a gimmick, and it doesn't require you to be glued to your screen. Today on Elite Trade Club, I'm breaking down a strategy called the Core Satellite Portfolio. It's a way to invest that keeps 80% of your money rock solid in a safe, proven foundation, while the other 20% targets powerful trends like AI, semiconductors, or small caps to give you an extra performance boost. Think of it as adding rocket fuel to a reliable engine. By the end of this video, you'll know exactly how to build it, which ETFs to pick, and how to maintain it with almost zero effort. Let's go in. Here's the problem with just owning the S&P 500. Don't get me wrong, it's fantastic. It's given investors about 10% annual returns for decades, but it's concentrated. It's basically a bet on large-cap U.S. stocks, especially tech giants. Right now, the Magnificent Seven stocks drive almost all the performance. To put it in perspective, those 7 companies, Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla, now make up over 30% of the S&P 500's total weight. That means when they sneeze, the whole index catches a cold. The problem isn't performance. It's concentration risk. If those stumble, your whole portfolio stumbles with them. So how do you keep the stability of the S&P but still position yourself for higher returns? That's where the core satellite philosophy comes in. The core is your anchor. About 80 to 85% of your portfolio goes here. It's boring on purpose. It's your safety net, your sleep well at night money. The satellites are your edge. About 15 to 20% of your portfolio gets deployed into carefully chosen high-growth areas. AI, semiconductors, small caps. They're like booster rockets attached to your stable foundation. You can think of satellites as tactical bets that let you benefit from innovation cycles. Things like renewable energy, AI, or space tech. They don't need to be permanent. You can rotate themes once or twice a year based on what's trending. This gives your portfolio flexibility without making you a full-time trader. And here's the psychological trick. Because your core is untouchable, you don't get emotional when your satellites swing up and down. You can let them work without panicking. So let's start with the lazy foundation. The champions here are simple. Vanguard's S&P 500 ETF, ticker VOO, or iShares Core S&P 500 ETF, ticker IVV. They're virtually identical. Both charge an expense ratio of just 0.03%. That means for every $10,000 invested, you pay about $3 a year in fees. That's almost free. Year to date, the S&P 500 is up roughly 10% as of mid-2024, powered by names like Apple, Microsoft, and Nvidia. And while that's great, remember, it's still concentrated risk. So here's the play. Allocate 80% of your portfolio to VOO or IVV. That's it. That's your lazy core. Set it, forget it, and don't touch it. Next comes the fun part. Satellites. These are your growth engines and the areas that can truly outperform the index. Satellite 1, artificial intelligence and cloud computing. AI is the mega trend of the decade, but here's the twist. All AI runs on the cloud. So instead of just buying Nvidia, you can own the entire ecosystem through a thematic ETF like First Trust Cloud Computing ETF, ticker SKYY, or Global X Cloud Computing ETF, ticker CLOU. These ETFs get you diversified exposure to SaaS providers, cloud platforms, and infrastructure companies that power AI behind the scenes. These ETFs include holdings like Microsoft, Amazon, and ServiceNow companies sitting at the center of the AI revolution. According to industry forecasts, global cloud spending could surpass $800 billion by 2027. That steady growth provides both stability and upside, especially as more businesses move to AI-driven services. Satellite 2, semiconductors. Next, semiconductors. Each piece of tech from iPhones to self-driving cars needs chips. The ETF play here is VanEck Semiconductor ETF, ticker SMH, or iShares Semiconductor ETF, ticker SOXX. These hold giants like TSM, Nvidia, and ASML. And the numbers don't lie. Over the past 3 years, semiconductors have crushed the S&P 500's performance. And that momentum doesn't seem to be slowing down. With governments worldwide investing in chip manufacturing through initiatives like the U.S. CHIPS Act, the sector is set for long-term tailwinds. Even during market pullbacks, demand for processors in AI, gaming, and electric vehicles keeps the industry resilient. Satellite 3, the Contrarian Bet. Finally, the contrarian play, small caps. Right now, small cap stocks are cheap compared to large caps. If the economy stabilizes and interest rates trend down, small caps could roar back. The ETF here is iShares Russell 2000 Growth ETF, ticker IWO. It's riskier and it's more volatile, but the rebound potential is massive. So how do you split the 20% satellite portion? Here's a sample allocation. 10% to semiconductors, SMH, 7% to cloud computing, SKYY, and 3% to small caps, IWO. That way, you're diversified across different growth drivers while still keeping satellites manageable. Let's talk numbers. Past performance isn't a guarantee, but it does give us insight. Take Portfolio Visualizer and backtest two setups. Portfolio A is 100% VOO. Portfolio B is 80% VOO, 20% SMH. Over the past 5 years, Portfolio A delivered solid returns, but Portfolio B outperformed significantly thanks to the semiconductor sector's explosive growth. Yes, volatility was slightly higher, but the reward more than made up for it. Here's the key. The satellites supercharged the returns, while the core kept the foundation stable. That's exactly the magic of this strategy. Now, be realistic. You won't always beat the S&P every single year. But over time, by capturing powerful megatrends, you give yourself a higher probability of long-term outperformance. So how do you actually put this into action? Step 1, choose your broker. Fidelity, Vanguard, Schwab, any of them work. They all offer commission-free ETF trades. Step 2, allocate. Drop 80% into VOO or IVV. Divide the other 20% between your satellites, AI, semiconductors, small caps. Step 3, rebalance the lazy way. Option A, super lazy. Just put new contributions into whichever part is lagging. Option B, annual tune-up. Once a year, check if your satellites ballooned past 20%. If so, trim them back and add to your core. That way, you're systematically selling high and buying low. So there you have it. The lazy investor's secret isn't about sitting on the sidelines. It's about working smarter, not harder. The truth is, most investors fail not because they pick the wrong stocks, but because they overtrade, panic sell, or chase fads. The core satellite portfolio solves that by giving you a structure and a system that grows with you, not against you. That's the real secret behind the so-called lazy approach. With 80% in the S&P 500 core and 20% in targeted satellites like AI, semiconductors, and small caps, you get the best of both worlds: stability and outperformance potential. Now I want to hear from you. Which satellite excites you the most? AI, semiconductors, or small caps? Drop your pick in the comments. If you found this strategy helpful, do me a huge favor, like this video, subscribe to Elite Trade Club, and hit the bell for more strategies to upgrade your investing game. Thanks for watching, and I'll see you in the next video.